All right, welcome everyone to the webinar on economic and BTR landscape for multifamily investors. My name is Jordan Berger, and I'm the co-founder of CRE Daily, and I'll be your host for today. In today's discussion, we'll be unpacking the current state and future outlook of the build-to-rent market. This session is tailored for investors seeking insights into the dynamic and growing sector within the multifamily real estate market. Before we dive into today's webinar, I want to thank Redwood Partners. And without further ado, let's jump into our first speaker. Our first guest speaker today is going to be Don Walker, a managing principal at John Burns Research and Consulting. Don is a recognized expert in the single-family rental and build-to-rent market with over a decade of experience advising investors and developers. His diverse background includes leadership roles in home building finance, consulting, providing him with a comprehensive understanding of real estate landscape. Our second guest speaker we have is Steve Kimmelman, the founder and CEO and executive chairman of Redwood Living. Steve is the visionary leader who revolutionized the apartment rental industry by pioneering single-story open floor plan apartment homes with the private garages. His commitment to remarkable living has driven Redwood Living's success, now boasting a portfolio of over 120 neighborhoods across 8 states. Welcome, gentlemen.
Thank you, Jordan. I'm happy to be here. The Redwood portfolio consists of 21,000 single-story Redwood apartment homes with attached garages across 9 states. 17,500 of them have already been delivered, and 3,500 are under construction in various stages. In addition, we have a pipeline of 5,000 units.
Excellent. Well, we're certainly glad to have you as a partner, and we're delighted to jump into today's webinar. So without further ado, let's get to our first question. And our first topic today is we're going to talk a little bit about what is happening with the broader economy in regard to jobs and wages. Don, if you could start us off.
Yeah, sure. Happy to, Jordan. And thanks for having me here. Build to rent is something that I'm passionate about. So I'm thrilled to participate. So on the broader economy front, from a job point perspective, things are still pretty solid. In January alone, I think we added a little over 350,000 jobs. We still have almost 9 million job openings around the country, which is great. It is down from around 12 million about 2 years ago, but still doing very well from that front. And from a household income or wage perspective, last year in 23, I think we realized about almost a 4% average wage increase. We're forecasting a wage increase of about 3% to 4% over the next few years. We think we will have a little bit of a economic slowdown because of the spike in interest rates as the Fed is trying to tame inflation. But overall, our forecast is positive household income growth, but slowing job growth again, mainly because of the Fed's attempt to slow down the economy to reduce inflation.
Thanks, Don. Steve, you want to give your comments on that as well?
Well, John Burns has more data on this matter than I do. I do read Bloomberg and the Wall Street Journal, but that's primarily where I get my information from. But I happen to love John Burns' data, and everything that Don said, I do.
Excellent. Well, I think that teases up for our next question, which is perfect for you. And we would like to know, what are the current trends regarding domestic migration and international immigration, and how could that impact demand for rental homes? Just your thoughts on that.
Well, we have a number of factors that we consider when we enter a new market. And one of them, of course, is population. So any increase in population, especially an increase in population where the median income is north of $75,000, typically will increase the demand for our Redwood apartment homes. And we have obviously the long-term prospects and the direction of the population in the United States is definitely will be increasing, in particular, the aging population, which by 2040 will be north of 80 million people over the age of 65, which should substantially increase the demand for a single-story apartment home.
Jordan, if I could jump in and add to that,
Please do.
I totally agree with what Steve said, and just probably a little bit more color. to add to that. I think coming out of the pandemic, governments around the world threw a lot of economic stimulus at the situation so we wouldn't go into a real downward tailspin in the economy. And our theory is that has pulled forward some household formation. And the other thing that came out of that is technology allowed people to work from almost anywhere. And so we saw huge shifts in migration, people leaving high density cities, expensive cities, moving to where they could afford to live in a nicer house. Now that pendulum has swung back a little bit because a lot of the economic stimulus is worn away. And now some people are being called back to the offices. And so that domestic migration has slowed. Now, at the same time, for the first time in years, we've had some really good, positive international migration. And that has kind of offset the slowdown in the domestic migration. And Steve hit it right on the head. A lot of the population growth we're going to see over the next 5-10 years are going to be in those older households. So clearly there's going to be a demand for single level homes and probably smaller homes in general as the population ages.
Thanks, Don. That's a great point. And I think also that kind of dovetails into our next question here, which is what are the current trends regarding rents and occupancy levels in the built-to-rent sector, and why are they shifting? Obviously, that's directly impacted on the migration. But Steve, if you want to start us off.
Sure. As I mentioned, we are located in 9 states, which consist of 18 markets. The softest market for us at this time is Charlotte, North Carolina, because of the substantial supply. Everyone knows that if supply exceeds demand, rents will lower. On the contrary, on the flip side, we are heavily involved and have a substantial number of Redwood neighborhoods in the Midwest. Frankly, roughly 85% of our portfolio presently is in the Midwest. In the Midwest, we are not seeing an oversupply. And we have experienced in 2023 rental increases north of 5% and an NOI increase of over 4%. We're projecting in 2024 rental increases in excess of 4% and an NOI increase of over 2% for the calendar year 2024.
Yeah, I would add that our data and our monitoring of built-to-rent rent trends are quite similar to that. So what we saw, again, coming out of the pandemic with this surge in household formation is a lack of supply in a lot of these, I'll call boom markets where people were moving to. And overall, our data says that rents went up by about 16% on a year-over-year basis. And now what happened is a lot of builders started building a lot of new supply. We, as an industry, delivered about 87,000 built-to-rent homes over the last 12 months. And so that extra supply, on top of the bite of inflation, has caused people to not be willing to pay as much or able to pay as much for rent. So rent growth has slowed a lot, mainly in some of those boom markets that Steve alluded to. And so I'll call it the more steady markets in the Midwest, the rents probably didn't jump up quite as high, but our forecast is they're going to be more steady going forward, probably in the 2.5% to 4% a year range. And it's going to vary a lot by market, but generally we see the Midwest markets as being more steady than some of the other markets that are impacted by more of the boom bust swings.
Excellent. And do you anticipate a more softening with some of those top growth markets that we were accustomed to over the last 2 years, call it Miami and such?
Yeah, no, we think in some of the markets where a lot of supply has come online, the units are getting absorbed, but the rent growth is going to slow. I think overall we're looking at rent growth of around 1%, maybe a little under 1% in 24. And so we have some markets down slightly and others just modestly growing by, I'm going to say 2.5% to 3.5%. So it does vary a lot by market. But then our thought is, because of the capital markets, and I don't want to get too far ahead of what your question might be, Jordan, but Because of the capital markets, a lot of build-to-rent projects haven't been started, have been put on hold for a while. That's going to let a lot of these units that are under construction get absorbed. And so because of that, we're a little bit more bullish on rent growth in the outer side of our forecast in toward the back half of 25, 26, and 27, seeing progressively stronger rent growth.
Thanks, Don. Yeah, and we'll jump into capital markets a little bit later on in the webinar, as well as kind of the difference in what's happening with the Midwest versus the Sunbelt. Before we do that, Steve, my next question is for you, and I would like to just kind of understand, what is your broad outlook for the BTR sector, and also how is the housing shortage affecting that in your outlook?
Jordan, I am 100% optimistic about the future of the BTR industry, really the entire housing industry. The demand for housing units exceeds the supply. In particular, concerning the BTR segment, whether it's a single-family home, townhome, or single-story Redwood apartment home with attached garages, I predict, and Redwood predicts without hesitation, that the demand will always exceed the supply, and that every suburb will benefit from a Redwood neighborhood, especially when you consider the population is aging. And the fact that there are tens and tens of thousands, hundreds of thousands of homes that were built in the 80s, the 70s, the 60s, that are no longer as functional and serve the purpose that they did back in the 80s and 90s. The people living in those homes right now do want to move. They no longer want to deal with the deferred maintenance or the hassles of living in a home. And when they decide to move, and that typically does happen when they see a Redwood neighborhood, we expect them to seriously consider selling their home and relocating to a Redwood apartment home. So we are all in America. We believe that this country eventually will have a population north of 400 million, hopefully sooner rather than later. And the demand's going to just continue to grow for single-story apartment homes with attached garages.
Steve, appreciate it. Thank you very much. We'll dive a little bit more into that topic as well later into the discussion. But just to kind of pick back up of talking about trends in the broader housing market, do build-to-rent projects still command premiums relative to scattered single-family rental homes and or apartments, in your opinion?
My answer is based really on research that John Burns compiled and populated and included in their monthly report. Based on their research, they're saying there is a premium that people do pay more for a single-story apartment home with attached garages versus the typical garden-style apartment home, three-story apartment home in the suburbs. For me personally, our company, we always try to maximize the rent that we can obtain on an annual basis. And that's determined by supply and demand. So I'll have to defer to Don, who I think will give a better answer to that question.
So I agree with what Steve said. We've looked at many different classes of product in the built-to-rent space, and it definitely gets a premium. And that premium can vary quite a bit based on how well executed the built-to-rent community is versus an apartment or versus the scattered single-family rental homes. Definitely still getting a premium. I would say the premium has come down a little bit, probably for a couple reasons. One is there's just now, it's not as uncommon to have multiple built-to-rent projects in a certain city. So people have more choices. And also, as I talked about earlier, the inflation of rent growth jumped up dramatically, faster than scattered single-family rental homes. And so that premium has come down a little bit, but it's still quite a substantial premium overall.
I want to point out that without question, the cost of owning a home is greater than the monthly cost of living in a Redwood apartment home.
That's a great
I'll totally back that up as well. The cost of owning a home, given the spike in interest rates, as well as continued home price appreciation, it's almost at a record level regarding compared to renting an apartment or renting a single family rental home. So yeah, the monthly cost of home ownership is much, much higher than the typical apartment or single family rental rates.
That's actually a great point, because let's talk about who rents build-to-rent communities. I mean, what are the things they look for, Steve? Like what is the driving factors that your renters are looking for when they're choosing your neighborhoods and your communities?
We have baby boomers, we have divorcees, we have couples, we have, of course, retirees and empty nesters. Over half of our population is over the age of 55. Really, somebody who wants peace and quiet, convenience, the ability to have a 2-car attached garage, plus 2 parking spaces in front of the garage, the drive into the garage. Truly, a Redwood apartment home is a home more than your typical garden style apartment. We find, based on our resident surveys, that what the residents love the most is the 2-car attached garage and the peace and quiet, the fact that nobody lives above you or below you.
Which you coined, which is what makes Redwood so unique, and why you guys are so successful. And let's kind of pivot a little bit into the broader scope. And Don talked about this a little bit earlier on in the discussion, but what is going on in the capital markets? I read and at CRE Daily, we had an article last week where we talked about Wall Street building entire communities and built-to-rent communities instead of just going and buying individual homes, because it's producing better returns. Essentially, exactly what you guys do at Redwood. What is happening with the fundraising machine, the lending markets, investors, the equity? I mean, what are you seeing on the ground floor, Steve?
These past 3 years, we have raised over $400 million in equity. Historically, Redwood was born in 2002. Historically, we were able to, upon obtaining permanent financing, we were able to return 100% of the investors' equity investment plus a coupon rate. But because Chairman Powell has decided to increase the cost of funds and increase the mortgage constant, that business model does not exist at the present time. Consequently, we are unable, upon permanent financing, to return 100% of our investors' equity investment plus their coupon rate. Historically, they would, when they received their money back, would reinvest in a new Redwood neighborhood. Consequently, our growth has slowed down. In 2022, we closed on 22 construction loans. In 23, 9, and in 24, we project that we will close on 10 construction loans. We are able to obtain construction financing, and we are still able to obtain equity, and we hope to close on land that will allow us to build roughly 1,100 units in 2024.
It's quite the impressive track record of 30 years. And I think the last time we spoke, you guys have around $5 billion in assets under management. Is that correct?
That is correct.
Wonderful. Don, do you want to give your thoughts a little bit on the broader scope of what's happening in the capital market space? Maybe you can talk a little bit about more at the institutional level as well, and what you're seeing, why everyone is hot for build to rent right now.
Well, I think Steve did a great job explaining what's going on, and a lot of the challenges in the capital markets were driven by the higher interest rates, which were required to pull down inflation. And so, yeah, right now, because of, the cost of capital from an interest rate perspective is almost tripled. And so it has really hurt the financial feasibility of a lot of new projects, not all, but a lot. So we think with slowing rent growth, higher cost of capital, still higher construction costs, that the starts for build to rent are going to be down 50 to 80%. So it's a pretty big slowdown. So what Steve is talking about is happening nationwide. There is still capital available, but it's being much more selective on who they're working with. Somebody needs to have a track record of success, kind of like Redwood, and those are the groups that can attract capital. But clearly, right now, a lot of investors are on the sidelines. A lot of banks are a little bit concerned. So the availability of capital in general is down for income-producing assets, no matter what type, really.
You're absolutely right about that. And I think also impacting the bottom line is, this time of the year is taxes. Steve, can you talk a little bit about real estate taxes and how that impacts or changes things for investors and how you guys approach real estate taxes in your communities?
Of course. I want to just point out one thing that Don mentioned or made reference to. It's not only the increase in the cost of funds that has been a major headwind, but also the increase in cost of construction. Since COVID-19, because of the supply chain chaos, our cost of construction has increased, excluding inflation, by roughly 30%. And it has somewhat leveled off, but it has not gotten back or returned to the good old days. And that has happened, has definitely had an impact on our development yield. We're always looking at ways to how we can reduce the cost. And part of it is the cost of materials, but another increase in costs that is unrelated to labor or material costs is the cost that municipalities are charging developers, whether it's water and tap-in fees or design and landscape requirements. But whether it's the government, whether it's the vendors or the municipalities, when they all increase the cost of construction, that is definitely a major headwind for all of the developers in the housing industry. Concerning real estate taxes, that is our largest annual expense other than debt service. And the combination of increase in real estate taxes and property insurance, this is definitely a negative on the NOI. And residents don't receive any benefits when a developer or operator spends more money on property insurance costs or an increase in real estate taxes. So when a municipality or cities or states focus on increasing real estate taxes, that is one consideration that we take into account on determining whether or not we will build a Redwood neighborhood in that location.
Excellent. I appreciate that, Steve. I do want to return back to, again, another thing we had talked about, which is on the minds of every investor right now, which is the shift you're seeing in the most competitive rental markets across the country. A recent report, I think, just came out with Rent Cafe, which I believe is backed by Yardi. But they had talked about that the top 20 markets are now in the Midwest, which has continued to take up a larger share. Don, I'll start with you. What is this shift that's happening away from, call it the Rust, away from the Sunbelt into the Rust Belt a little bit? Can you talk about why that's happening, what is projected to happen over the next 12 to 24 months?
Yeah, happy to, Jordan. Now, I'm a big fan of Yardi. I didn't see that article from Rent Cafe, but were they talking about rent growth or what?
Rent competitive, the most competitive markets. So essentially talk about rent competitive. Which markets are most competitive? So Miami's still ranked number one in their most recent report. But beyond just what the data found, just your thoughts in general about what's happening with the shift towards more stronger rent growth in the Midwest and more cities appearing like Milwaukee and others appearing in those numbers.
Sure. Yeah. No, I think it goes back to what I think I said earlier is that some of the high growth markets where people were moving out of the expensive coastal areas into more affordable areas or where there were a lot of jobs. So I'm thinking Dallas, Austin, the Southeast, some of the Florida markets. Builders followed, built a lot of houses, and in some cases, maybe a few too many. And so that rent growth has slowed. Whereas in the Midwest, it's been more of a steady growth, and steady growth in population and household and jobs, as well as housing supply. And so because it's more balanced, that's where we're forecasting a more consistent rent growth going forward. Again, in that, I'll say 2.5% to maybe 4.5% a year through 27. Just because it didn't have such the violent swings up, it's not going to have the violent swings down as some of the, I'll call it the more boom markets that we saw over the past few years.
Thank you. I appreciate that. Steve, you want to give your comments real quick? I mean, I know you're incredibly bullish on the Midwest, which is why you're there and building communities. But is there anything you're seeing as well, just in the trends of some of the top markets? I know you talked a little bit about the Carolinas softening a little bit.
Yes, we do love the Midwest. We are in 6 of the 12 states. The gross domestic product of the Midwest is $4.2 trillion, which exceeds Germany's, UK's, France's, and is double Canada's. The population is 70 million people. But we are fully aware of the fact that the jobs and population is heading towards the Sunbelt. And in our vision, we want there to be a Redwood neighborhood in every suburb in America. There will be a time when there is a Redwood neighborhood in Arizona, Texas, Florida, Alabama, Georgia, and all the Sunbelt states. We do not have a printing machine that makes money at Redwood. And so we don't have the ability to just generate enough equity to invest in all of those states simultaneously. You know, one of the jobs, we have to allocate our resources. And at the present time, we're allocating them primarily in the Midwest. But we look forward to the day when there are Redwood neighborhoods in the Sunbelt. And that will happen in the near future.
I certainly believe that, and I look forward to that. And I can't wait to go visit one, because I'm in the South, and I can't wait to go check them out. Just if we could stay on you for one last question as well, Steve. You know, you're not just building neighborhoods. You know, you're building communities. Can you talk a little bit about what makes a Redwood community so special? I mean, these homes. I mean, like you're doing more than just building large neighborhoods where homes are, right? Can you share a little bit more about your unique style of homes and neighborhoods you're building?
Sure. Well, of course, it starts with the product, but then right after the product, it's the employees. We have amazing employees, and we have core values, which is the foundation of Redwood. And core value number 4 in particular is deliver more than expected. So our neighborhood managers and service techs that live on site, for them every day, they want to make the residents happy. We are fully aware of the fact of making 4 people happy: the residents, employees, investors, and our contractors, because it's our contractors who make and build our product. A Redwood neighborhood feels like a home because it looks like, and it is very similar to homes. From the standpoint, most homes in the suburbs have attached garages, and they do not have another home above them or below them. So we make sure that people are safe, secure, have peace and quiet, and enjoy a maintenance-free living.
And Jordan, I'm sorry if I could just add to that, because I think what Steve said is so important. What we found in our build-to-rent tenant survey that we did last year, and I think it was the first national survey, and we had over 6,000 responses. In addition to what people liked about their home, what we found was a lot of them are renters by choice, and they're choosing to rent for a variety of reasons. But some of the key reasons why they rented in a build-to-rent community was for that maintenance and the service they get from having a maintenance tech there or an on-site leasing agent That's so important to them. And I think Steve's company rates very highly in that regard. So I think that's one of the reasons why they're so successful is, as Steve pointed out, the team they have in place in these communities is what really drives it. I think that's the secret sauce to a successful build-to-rent community is the people.
I couldn't agree more. I couldn't agree more. And I think a lot of these families, as you mentioned, they've got a lot of pressure from inflation and others on their mind. The last thing they want to know is, are they coming home to a community where they're going to have to worry about their water or their pipes and, is the house constructed okay, right? I think, you must be doing something clearly right. You've been in business for 30 plus years, Steve. So with that, we are just out of time. So before we wrap up, Steve, I want to just turn over to you and give any closing remarks on Redwood and just the opportunity, if you could, for investors and just kind of wrap up before I say my last remarks here.
Well, first, I want to thank you again for having me on the show. And it's a pleasure being with you. And of course, with Don. Presently, right now, we are raising equity for 2 Redwood neighborhoods. And we have been successful now. Our first Redwood neighborhood was 2002. We have 150 Redwood neighborhoods, and we have always returned our investors' money back, plus their coupon rate. We have such a good track record that our investors that have received their investments back previously have just reinvested them in new deals. We are obviously always looking for new investors, and we welcome any potential new investor you can contact me or our investor relations, and we'll give them more information regarding Redwood neighborhood opportunities. Presently, they're located, the ones that we're presently raising for are in the state of Ohio.
Excellent. And I'm sure there'll be some more details shared after the webinar as well from your team for everyone that signs up. I want to again thank Redwood, Steve, for your time. They've been a long-term partner with CRE Daily since we've started, and we really appreciate your support. I want to thank Don, and I want to thank John Burns, Research and Consulting, also a close partner of CRE Daily. We actually just released our second edition of our Fear and Greed Index in collaboration with John Burns, which is really the first commercial real estate index tracking kind of sentiment in the market. So I want to thank you both, gentlemen, very much for your time today and for joining us. For the audience that's watching this, I believe there were a few slides, potentially some data points prepared for this session. So if you want to reach out to the Redwood team, I'm sure they'd be happy to share that with you as well. Once again, thank you for joining us today, and we're a pleasure to have you. And we look forward to seeing you at the next CRE Daily webinar. Have a good one.